You know how it is. Every single election year, it's the same story. A flood of promises for new spending, sudden tax cuts, and all these grand projects. But what if I told you there's a predictable, almost hidden economic pattern underneath all that political noise? Well, today, we are diving deep into the fascinating and frankly crucial economics of how we vote. It's the question we've all asked ourselves, right? When a government suddenly unveils a new subsidy or a tax break just a few months before we head to the polls, is that a genuine attempt to help us out? Or is it a really smart move to win our vote? To get to the bottom of this, we're going to lean on some fantastic analysis from business consultant and trade expert Emad Joinal Abdin. His work pulls together research from huge global institutions, and what it uncovers is this cycle that just repeats itself over and over in democracies all over the world. All right, so here's our game plan. First, we'll explore what's called the election year effect. Then we'll get into the core idea behind it, the political budget cycle. After that, we are literally going to follow the money and look at the hard data. We'll see what this does to the markets. And finally, we'll talk about how we can actually strengthen the whole system. Okay, so let's get into it. What exactly is this predictable pattern? Well, it has a name. And honestly, it's the key to understanding how politics and our wallets are so deeply connected. It's called the political budget cycle. And here's what it means in plain English. It's the habit that governments have of tweaking their spending and tax decisions right before an election. The goal? To create a quick, short-term economic buzz that makes voters feel good, even if it means creating a much bigger financial headache down the road. And get this cycle isn't always a one-size-fits-all strategy. You've got the opportunistic model, where a government just tries to make everyone happy with broad giveaways. Think about a tax rebate that lands in everybody's bank account. Then there's the partisan model, which is way more targeted. One party might push to create jobs to fire up its base, while another might focus on fighting inflation. The result is you get these big economic swings depending on who's in charge. So that's the theory. It sounds plausible, but does it actually happen? Is there real proof? Oh yeah. The data is shockingly clear. Let's follow the money. This right here is the headline number. When you look at dozens of countries, the data shows that a country's budget deficit, that's the gap between what a government spends and what it takes in, grows by an average of 0.3% to 1.0% of its entire GDP just in an election year. That is a huge, measurable, and predictable pattern. And look, this isn't some fluke from one study. This is a global thing. An IMF paper, it found deficits in low-income countries jump by a full percentage point of GDP, mostly from just more government spending. A World Bank study saw the same thing in emerging markets, usually fueled by tangible stuff like higher wages for public workers or new subsidies. The data couldn't be clearer. When an election is coming, the spending taps get turned wide open. I mean, you could practically set your watch to this cycle. A year out from the election, everything's pretty normal. Then around that 6-month mark, boom, the goodies get announced. On election day itself, uncertainty is at its absolute peak. And then, like clockwork, after it's all over, the belt-tightening starts. That usually means spending cuts or new taxes to pay for that pre-election party. The big problem? That debt often sticks around for a long time. Now, this isn't just about government spreadsheets and boring accounting. No, this cycle has very real consequences that ripple right through the financial markets, affecting investors, businesses, and, yep, you and me. So why does this happen? It boils down to one word. One single thing that financial markets hate more than anything else: uncertainty. Not knowing who's going to be in charge, what their policies will look like, or how stable the country's budget will be, it just makes investors incredibly nervous. And that nervousness isn't just a feeling. You can literally see it in the data. Stock market volatility goes through the roof. You can track it in indexes like the VIX, which people call the fear index. Big money investors pull their cash out of countries to just wait and see what happens. Governments suddenly have to pay more to borrow money, and currencies can swing like a pendulum. This is real money moving around the entire globe, all based on political risk. And the source analysis really hits the nail on the head here. It's not just a short-term problem. These predictable cycles of spending and then cutting can seriously damage a country's long-term financial credibility. We're talking about creating real instability in the economy. That is a massive price to pay for a short-term boost at the ballot box. So is this just inevitable? Are we stuck with this boom and bust political spending forever? Well, not necessarily. The analysis also points to some really solid ways we can build economic guardrails to protect the system from its own worst impulses. Here are the 4 big ones. First,
You enforce clear fiscal rules, like strict debt limits. That just makes it harder for politicians to go on a wild spending spree. Second, you fiercely protect the independence of central banks, so they can focus on long-term stability, not short-term politics. Third, you demand transparency, things like independent audits, which makes it way harder to hide the true cost of all those promises. And finally, maybe the most important one of all, voter education.
Because really, that's what this all comes down to. The best defense, the most effective defense we have against these cycles is a combination of strong, independent institutions and a public that knows what's going on. When voters understand the long-term price tag that comes with those pre-election gifts, they're just less likely to be swayed by them.
And that brings us to the final question, one for you to think about. The next time you're heading to the polls and you see all those tempting new promises being announced, are you going to be looking at the promise, or are you going to be looking for the price tag? Thanks for joining me.